All right, all right, all right, you loyal listeners. Welcome to another episode of Agents Influence Conversations with who? Me, Jason Cass. And today I have a special one for you. Somebody that Hanley had on, and I was listening when Hanley had him on, and I said, man, I got to get this guy on because I got certain questions that I've got to ask him. And so today we have Kyle Nakatsuji on. Did I say it right, Kyle?
You sure did.
I mean, we in the green room, loyal listeners, we have been rehearsing it over and over, and he's getting mad at me. He's like, Jason, goodness, no, that's a complete lie. That's a complete lie.
30
No,
times at least.
you know what, Kyle, though? My loyal listeners are listening right now, and they know how I butcher names. So they're actually probably applauding me is what they're doing. So I do appreciate that very much. And, Kyle, I'm looking forward to this conversation with you. Just for you loyal listeners, we might be having another guest coming in, which is Jeff Shee. Jeff has some questions. He follows Kyle and has a lot of things and thinks very highly of him and wanted to ask some questions. Jeff is in the middle of another meeting right now, so he probably is going to pop in. Just loyal listeners, in case all of a sudden you hear Jeff start talking, that's the reason why. So let's see. It says it's allowing him to call in. Isn't that crazy? I've never seen this before. So, Kyle, you ready for this?
I think so. I hope
Good.
so.
I got a lot of questions, and I just want to know what you do. And I've heard your name from so many people. Like I said, after I listened to Hanley, I said I got to get him on. So, Kyle, we do have this little thing. I know sometimes these questions, it's like where people ask these silly little questions. Well, guess what? I was doing it in 2011 before all these other people were, and so we still keep doing it. So the things we do want to know, though, are you an iPhone or you a Droid user?
I am an iPhone user.
You're an iPhone user. Are you a dev guy, or are you more of the business admin part?
Oh boy, far from dev. I committed code once because they set me up in like a very idiot-proof way to do it, but that's about as far as I've gone. I'm a computer enthusiast, not a
Okay,
so much a
computer enthusiast.
computer.
There you go. I like that. Yeah, so we always find that like the dev, if I have somebody on who's like part of the dev team or they're a developer, they always have the droids. But if
hmm
I usually get the upper management CEOs, they always have the iPhone. So that's cool. Hey, do you love to win or do you hate to lose?
Yeah, this is a great question. The answer is yes, but so if I have to pick one, I'll say I'm going to pick hate to lose, and only because I think it's behavioral. So I think if you look at like Kahneman and Tversky, they talk about prospect theory and loss aversion. I think as humans, we are wired to dislike losing things more than we're wired to like them. So I'm just going to go with behavioral psychology and say I hate to lose.
You like behavioral psychology?
I do, big
I'm
time.
like obsessed with it too, dude. I really am. Like it could be the boringest book to everybody else, but if it's behavioral psychology and thoughts and the way things work, I mean, oh man, I am so the same way.
It
Um,
works.
it really does. It really, really, truly does. And I think people kind of play it off. And, sometimes when they learn things that can work with behavioral and the way that we work and how other people work, people kind of see it as like, well, you're just kind of, I don't use the word con. I can't think. You're kind of conning them into getting them to believe what you want. And it's like, no, really, it's just maybe the way we communicate now with each other is not proper. But now that we understand the brain and how it works, we could actually communicate better if we actually did that. Does that make sense?
I completely agree. I don't think it's conning or manipulation. I think it's just engaging
Manipulation.
with people on the terms that, you know, are, are most likely to generate an outcome that's right for whatever party.
Yeah, I agree with that. I agree with that. I'm trying to think of this thing. I was just Sarah Nicholas, who runs, is my right hand person inside of agency intelligence. She has a master's degree in healthcare administration, and she's got like some kind of degree as well in behavioral science. So it's really, really cool when her and I start talking. And I was talking about, have you read the book Atomic Habits?
I have, yes. James Clear.
Come on now. Come on now.
Good
You know what
stuff.
I'm
Yeah.
talking about?
Yeah,
That
yeah,
is
yeah.
some good stuff. I actually, Kyle, am using that book into 75 hard. You've heard the 75 hard thing. This is
hmm
this workout. So yeah, so I start 75 hard on September 20th after my brain share event. But I have been slowly working into it rather than just going cold turkey, using Atomic Habits.
That's
And the way
great.
that he talks about to quit doing things and slide, man, he's blown my mind. And I love that kind of stuff. That's cool.
You
And
and
I have
you and Hanley, I think half of Hanley's Twitter feed right now is him like just moving heavy weights around. He's so you guys are both on the program.
all the podcasters, we have our own little Facebook chat that we've had for years, and we're all hyping each other up on doing this 75 hard. So,
It's awesome.
anyways, yeah, it is. It's cool. I can't wait to do it. Last question, man. If there were two things in the world that got you to where you are today at Agency Intelligence, is what we think: skill or luck? Which has been a bigger factor with you, Kyle?
Yeah, I would say so. It's an excellent question. There's another great book if you haven't read it called The Success Equation by Michael Mauboussin. He talks about this thing called the luck skill continuum. So right, so it's never an or. It's always like what combination of luck and skill is involved in success in whatever you're doing, and you have to ask yourselves a couple of questions to figure out where your thing is on the luck skill continuum. So like for example, one question is, can an amateur beat a pro in coin flipping? An amateur can beat a pro pretty easily, right? There's a lot of luck involved. In chess, an amateur will almost never beat a pro. It's almost all
Oh.
skill, right? So like you can also ask yourself, like how skilled are the players on average? Because the more skilled the players are on average, the more luck actually has to do with winning because people are evenly matched. So you ask yourself these questions, you figure out where you are on the luck skill continuum. I would argue that as a startup, all the players are pretty skilled. Sometimes you see people who have never started a company before have these wild success stories. So it probably is more on the luck side than on the skill
Mm-hmm.
side if I apply
Mm-hmm.
these tests. And so I would say luck has a really big part to play. Our job then, our skill is maximizing the surface area you can apply your luck to. So your job is to make sure that you preserve optionality, that you hire super smart people, that you do things that have low downside and high upside. You maximize the surface area of luck, and then you hope luck happens. So the answer to your question is like I would say more luck than skill, but we try really hard to maximize our ability to get lucky.
Maximize that. I like that. So maximize that surface. That was good. That was good, Kyle. Wow, dude. And once again, man, what was that book?
The Success Equation by a guy named Michael Mauboussin.
Dude, I've never heard of that. I've never heard anybody. So that's good. That means if everybody else isn't reading it, you are. I want to be like you, so I'm gonna start reading the damn thing. Kyle, man, take us loyal listeners so we can relate. In 2-3 minutes, take us back to where you started and how you got to where you are now as the CEO.
So I'm a Midwest kid, was born and raised in Milwaukee, went to school in Wisconsin, got a law degree and an MBA at the University of Wisconsin-Madison. Didn't go to class very much. I spent most of my time out in the community working with startups because that's what I wanted to do. And
Wow.
was an attorney briefly, kind of a crappy one. So a brief stay was good for all parties, I think. And then from there, was fortunate to join American Family Insurance in Madison to help start their venture capital team back in 2012. And through that experience was really exposed to how insurance companies run. This sort of the insure tech movement really started to build up some momentum in the
Mm-hmm.
2014-2015 time period. And so we found ourselves just in the middle of this crossfire of like really smart people coming up with ideas to change the industry. And we were making some investments and building some theses on how we'd invest American families' money, one of which was on building a next generation insurance carrier. There were folks who were building things to help insurance companies. There were only a small handful of folks who were building insurance companies of their own. And so
Okay.
we were building a thesis on how to do that. And, we landed on an idea that was a little contrarian at the time, which was um, building the next generation insurance company wasn't about finding the sort of silver bullet, whether that was like telematics or a different way of pricing or chatbots or what have you. It was really about building fundamental cost structure advantages because those fundamental cost structure advantages would create an economic surplus that you could then use to do many things right for customers over the span of time. In essence, the theory was insurance isn't a silver bullet game, it's a lead bullet game. And the way you win in that type of game is by having some foundational advantage that allows you to win over and over and over again. Our bet was that it was cost structure. We didn't see anybody building it. So in 2016, my co founder Derek and I left American Family to go build that next generation insurance company. They put some money in, they were our number one supporter from the beginning. Fast forward to today, Clearcover is that company. We think of ourselves as a next generation auto insurance company that uses technology to create a better cost structure, which allows us to offer consumers a better experience for less money. And we have a very long way to go, but we've grown pretty fast. We've made some progress, and we're proud of where we are.
So, Kyle, great, interesting. I mean, to be honest with you, there's so much. I should have been taking notes, but I can't listen and type at the same time. So, Kyle, so you're talking about this cost structure, okay? You're talking about stuff that I've done 600 of these and no one's talking about this stuff. I now see why Jeff Shee. Remember we were talking about this earlier. He was blown away by some of the stuff you were saying. Um, so everybody's trying to use technology though to lessen the cost somehow so that they can provide a better experience in that. And I'm not mocking you. I'm just saying that but I think they go out a lot the same way as traditional insurance companies do. They just happen to try and throw some tech in there. But like,
Hmm.
where was that different for you? And I don't. Does that make sense?
Yeah, yeah, for sure. So there are a couple things that you have to think of it differently if you're going to talk about us versus an established or incumbent carrier versus Clearcover versus some of the other startups. On the incumbent side of the house, there are two things that we think give us a bit of a leg up. We have many disadvantages, by the way. So this is not like to say we're better than them in all regards. Like these are two
Right.
things we think we do pretty well. One is we got to start with a blank sheet of paper in terms of technology. And it
Mm,
turns out when you're thinking about rebuilding a cost structure, that helps. This idea of not having anything old to deal with is important. Sometimes at these big companies, um, not doing the old stuff is much harder than doing the new stuff. You can do a lot of new stuff, but if you don't stop doing the old stuff, then oftentimes your cost doesn't change. And if your cost
true.
doesn't change, then you lack that fundamental advantage. So blank sheet of
Good
paper
call.
is super important. The other thing we do is there's this concept in the market we tend to think of as digital customer cost arbitrage, which is like a fancy way of saying digital customers are naturally lower cost to acquire and serve than an analog customer, somebody who wants a much higher touch experience. Because frankly, you just have to do fewer things for a digital customer than you have to do for an analog customer. And so if you were to build a portfolio that was indexed towards or concentrated in digital customers, you are very naturally going to have a lower cost structure than somebody who has a portfolio that is heavily weighted towards analog customers. So our bet was that blank sheet of paper, and we were actually going to build a portfolio that was heavily weighted towards digital customers. Those two things would give us pretty sustainable cost advantages versus our peers who don't have that blank sheet of paper and who have very large customer bases that are weighted towards analog and are going to be hard to shift. If I think about the comparison versus a startup, it goes back to this idea of the the concept we like to use is the fox and the hedgehog. You ever heard the sort of the parable of the fox and the hedgehog?
Even if I have, I want to hear it from you, Kyle.
um, so in short, the fox knows one big thing, and the hedgehog knows many small things. And we think in order to be successful as an insurance organization, you have to be more hedgehog than fox. It's not about doing one thing right or special. It's about doing many things right over the span of time for customers. And the way that you do that is not by building your entire company around that one special thing you think you do, but building your company around a foundation that allows you to do those many things right over time. And for us,
Gotcha.
this was this idea of cost structure. The underlying thesis behind Clearcover was at a very high level, we can use technology to build a fundamentally advantaged cost structure, which will create an economic surplus. And then we take that economic surplus and we invest it in the four things we think every customer wants from their insurance experience: transparency, convenience, low prices, and superior value. Those are the only four principles of a good insurance experience in our opinion. And all we do is take that economic surplus created by the cost advantage and invest it in those four things again and again and again and again. And that we think is the fundamental and underlying advantage, or like the core mission behind Clearcover.
So that foundational, what did you call it? Because I can't remember the foundational cost structure. The cost structure allows you to have the excess that then goes into these four things, which are
Mm-hmm.
what you feel is the okay. I got you. I got you. Now, why don't you think? Why were you able to come up with this, you and your partner, and other people don't think this way, Kyle? What gave you this? What were you sitting around? What whiteboard made you finally go, oh, that's it? You know?
um, well, look, I think let's be honest. I'm sure that you have many, business owners who are also subscribers to your podcast. Like,
Yep.
all startup origin stories are really just a bunch of post facto rationalization. So, like, let's be honest, this wasn't like an epiphany that I had in the middle of 2015 and I said, that's it, this will change everything, right? Like, you rationalize the last 5 years of dumb stuff to get to the thing that sounded like this brilliant thing from the
So
beginning.
true,
So,
Kyle. So
right.
true.
So, like, I wouldn't say like we had this eureka moment. I think we had this idea that in order to build an insurance company that could sustain itself over the long term and really be differentiated, you should start by winning on cost structure, because cost structure allowed you to win on many other things. And like that idea morphed over time, but that was the core idea. And frankly, where that came from was probably just being in the room with a lot of smart people talking about things they thought were important. I'm pretty sure I haven't had an original idea in like 8 or 10 years. So I'm sure it was someone else's idea that I sort of took as my own. And if
I
they're
had a
listening,
friend
I'm
the other
sorry.
day, just the other day, Kyle. He said to me, he said, "Man, you sure have a lot of ideas." I said, "Yeah, not one of them's my own. I'm just the
Yeah.
only one that takes ideas from people who don't want to do it." And I'll be like, "Well, if you're not going to do it, I'm going to do that idea." No, I'm complete that. That's funny. What's making me laugh too is the conversation I was in and how that attributed. So you said that you were with American Family.
I spent 4 years at American Family doing venture capital work with that team.
Okay. Oh, so you weren't an agent or anything.
I weren't, no, we worked with everybody in the company, but I was part of the like startup investment team there.
Okay. Okay. Hmm. That's interesting. So Clearcover today, what does Clearcover do? If I needed to know exactly what they do, what do they do?
So right now we sell auto insurance. We're focused on a pretty broad segment of the market. It's a pretty digitally centric product. It's easy to buy. I think it's a product that's really competitively priced, very convenient for the customer to buy and engage with. We do some really cool stuff with technology on the back end. So here's an example. We built a product we call Clear Claims, and Clear Claims is allows you to sort of submit the claim via an app and get paid almost instantaneously. So the record for payment right now is 7 minutes from submission to payment. You submit it in the app. We use some AI to determine eligibility for instant payout, and then we're able to pay people out in a very short period of time. And so it's like it's a product that is digitally inclined, but isn't only for digital users. But it's affordable, it's easy to use, it's convenient. It hits on those four inputs that we think are super important. For your audience, one of the things that we do that we're very proud of, and I think is a little differentiating, is we are very we are very omni-channel as an organization, which is to say we sell our product direct, we sell our product through partners, and we also work with agents of all sorts. And this was, there's a longer story behind this, but this was a bit of a pivot for our business. Like we had to come to this realization over time. But a ton of our business now comes through our agent relationships, and it's
They
great
always need us,
business.
Kyle. They
It's
always need us.
it's
Kyle, I'm telling you,
it's a
they always come back to us. The old independent agent. Jeff Shee's on, but I don't want to interrupt you there, Kyle. But yeah,
Jeff.
so that was one of the omni channels. We're talking Jeff Shee. All you loyal listeners, Jeff Shee just popped in. But Kyle, you were saying so you're more omni channel in that, and so you have your direct, and then your partners. I assume, like, I know you're not, but like if that was like an Amazon or some kind of affiliate
Right.
partner like that, right? And
Yep.
then the independent channel, and you're noticing that that's where you're driving a lot of your revenue right now. Is that
We're getting
right?
a ton of growth out of that channel. Yep. There's a very, I mean, I'm preaching to the choir, I suppose, but um, we if you think about like consumer preferences in the insurance space, very very broad, like applying very broad strokes to this. There's about a third of the market, and arguably shrinking, that says what really makes me feel good is like a brand I see on TV, and like something that like that's like I get superior value out of having like some big brand behind me, and I'm willing to pay for it. And that's basically the captive agent channel at this point. There's another segment of the market that says I get a bunch of value out of convenience, right? Convenience for me is paramount, and like for me, convenience is like I just want to hop online and buy the thing, and that's the direct channel. And there's this big chunk in the middle, which has represented 30 to 40% of the market for a long time and has held fast, of people who get value out of abstracting the choice. So essentially, what they want is a professional to help them make the right decision. They don't want to deal with the insurance choice themselves. They'd like to abstract themselves from that choice, and that is this independent agent channel. And that's the one, candidly, like I'm super bullish on going forward, because the more people like fewer choices and they like being lazy. So the more we can take these people who want that convenient digital experience and give them convenient digital experiences where they are getting that professional advice and the choice has been
Mhm.
abstracted, the more they're going to come to it. So like we are very bullish on the IA channel, because we think that actually it'll steal a bunch of share from direct as these curated digital experiences start to occur, where folks can really like have someone help them make a choice and still get that level of convenience that they wanted from the direct experience.
Kyle, the reason why I love this is because so many people, as you said at the beginning, a lot of insure techs decided, hey, let's go create tools or software that would help them. And you thought, well, let's create a different channel for, the consumer to actually work with and stuff. But actually, you created the channel for us. Right. And that's what you're now finding out is because agencies like mine that, I mean, I've been virtual for a while. I have now because I bought agencies. I have them. But I started out virtual based in my home. And I mean, it's so hard to sell these policies when you didn't have the digital means like we do now. And before I introduce Jeff on, one of the things that you said, Kyle, which I thought was interesting, you said that it's around 2012, 2013, 2014, this InsurTech thing started really going. I was telling a friend of mine the other day who's kind of new to the business that, like, I used to get probably 2 to 3 calls a week from college kids. And they'd be like, hey, I'm working. There was a company out there called, or a group called The Foundation. And like all they did is they brought in like these college kids and said, hey, there's technology in these different sectors that need to be created. Go talk to them. So they would call us and they would be like, how can we help your business? What could we do better? And all this stuff. And then they realized like we didn't have the amount of money that the insurance companies had. So those calls stopped and they started going to the insurance companies, right? But what's funny is you did the same thing, but not really, because you accidentally ran into understanding what we really needed. Like back in 2012, 2013, the convenience that you allow the customer while giving us the access to that digital platform, that's what we were wanting in 2012 and 2013. And then they just kind of left us, and it's like, well, you guys don't have the money that these guys do. Right. And then they ran into those issues of they've got the old systems and all that stuff like that. Anything to add to that, Kyle, before I introduce Jeff?
No, bring in Jeff.
Loyal listeners always know Mr. Jeff Shee, the one and only, keeps the industry on lockdown. Jeff, man, sorry for your trouble getting in here, but I think you had a
I am
messenger or a
great.
meeting or something. How you
Excited
doing,
to
man?
be on this one. Kyle, you are a smart dude. I heard you a couple times on podcasts, and I was like, I want to ask this smart dude some questions so I can get some smart answers.
I told him that,
Uh,
Jeff. I told him.
you did tell me that. I'm not sure I
So
can live up to all that, but I'll try.
Especially with Jeff Shee, because he's a pretty smart dude.
I
So,
know.
so Jeff, we just been talking about his history. We talked about Clearcover, how they are and where they are. Before,
I
I
got a
want you to
few.
think of a question because I know you have many of them. But one thing I want to go back to, I know, Kyle, you said one of the 4 things was transparency. Is that where Clearcover comes from? No.
It's interesting. Yeah, Clearcover, I had to invent on a car ride to with my wife to her friend's house because it turns out that we needed to like incorporate the company and that we needed a name to incorporate the company. So yeah, the idea behind Clearcover was this idea of transparency for the customer and this notion that um, we didn't necessarily need to be front and center in the insurance sale. We were willing to like work with partners, work with other folks who had a stronger relationship with the consumer and maybe take a back seat in terms of in that relationship if it was the right thing for our customer.
There's some agencies out in America that have been around for 100 years. It'll be like Jordan Covers Agency. And that's not his last name. That, as you probably know, is an old term that we used for insurance, right? So
Hmm.
it's so crazy that you say one of those things is transparency. So I put it together thinking he's transparent in insurance, right? In the
That's right.
coverage, that is. So whether the story is or not for you and your wife, just use that. It sounds a lot better.
Okay, deal.
Okay.
Yeah, I'll take yours.
Jeff,
Yeah,
man, you got a
so
couple questions,
coming from
buddy?
a founder, today is a 2 year anniversary for Qualcomm and Quantum. So I have some cool questions to another founder, and
Congrats.
some could be a little bit personal, and I just love to hear your feedback on them. So growing up, you guys are coming up on a couple of years, right? And growing up in the insurance industry, who did you look up to? Who was your Mamba mentality, your Kobe Bryant, your Michael Jordans in the world before you are in your position?
Uh, Interesting question. Um, yeah, uh, I came up. I'll give you some. I'll sort of. I might meander around the question a touch, but
That's
like,
fine.
let me talk to you about the stuff that really influenced me a ton when I was trying to like dive deep and learn about the industry. So
Okay.
I went online and bought. You can still do this. You can buy all of the Berkshire Hathaway shareholder letters on Kindle for like $2.99. And I read every single one of them from Warren's very first letter. I read all of the Berkshire Hathaway letters because nobody understands the underlying dynamics of the insurance business, in my opinion, more clearly and concisely than Warren Buffett. So I read all of those shareholder
Wow.
letters, super, super
Wow.
critical in my development. The other thing that I read cover to cover, which was a bit more of a slog, but important, was Werner Modlin Chapter 4, which is part of the literature that actuaries have to read when they're studying for their exams. And Werner Modlin, it's actually available via PDF through through you just look it up online, and that was like really foundational in terms of understanding how insurance works, like how pricing works, how the companies work. So like that was a really so like I spent a lot of time with that thing. I got licensed as an agent, so I went and got licensed as an insurance producer. I didn't tell anybody I worked with because I didn't want them to know in the case I failed the test. But like I took the course, I went and took the test, I passed the test. I didn't get my license because I didn't intend to sell insurance. So I went through that. That was a big part of my learning experience. And then the last one is I would say like the collection of people around Glenn Renwick. So I also looked, they used to do this. If anybody from there is listening, maybe you should put it back up. But Progressive had all of their old investor relations videos online. Probably 24 months ago, they took them down or something like that. But you used to be able to go
Wow.
back to like 2011 and look and listen or watch all of the annual shareholder meetings. And I went through all of them. And I think like what Glenn Renwick did with that business and how he thought about building that company and how they thought about balancing cost and low prices and customer experience, like really transformational for everyone. So Glenn and Patricia and like all the folks around Progressive, I studied, but maybe more than anyone, I'd say Warren and his letters.
Wow.
Wow. Wow. That's unbelievable
I got
research
another
and,
one
and
since you
stuff
like
there.
research. So, these insurtech
Fire away.
IPOs has been the big news, right? Like VC and P investment into insurtech is this year there was more than entire last year in the first half. But the question always come up
Wow.
is how are you guys going to make money? Can you guys be profitable after the IPO? So, couple guys, Hippo, Roots, Lemonade, Metro Miles. So, if you had to have if you had to fix Roots and Metro Mile because they're on the news the most right now for not being profitable and not be able to grow at a great cost per acquisition because everybody got stuck in that Google sandbox. Unless you work with independent agents over, in America, if you want to go direct to consumer, you're stuck in that Google sandbox. And that revenue went up
Mm-hmm.
62% Q2 of this year versus Q2 of last year. We didn't grow 62% in population, just
Mm-hmm.
a whole lot of keyword bid went up. And Progressive and Geico over there standing over there
Mm-hmm.
said, you know what, we can drive the cost sky high. We're going to drive the bidding cost sky high. We can drive our expense, our underlying ratio high. Can you guys keep up? So Roots and Lemonade and Metro Mile is being burned out of their money right now. If you were their CEO
Mm-hmm.
in their position, how would you stay in the war? Just a softball question.
Hmm.
I'm
Yeah,
sorry.
no, no,
I'm sorry I allowed him to come, Kyle.
no big deal. No, it's a great question. Look, so there's a couple things. So one is we should first draw a distinction between what I would call a systemic lack of profitability and a non-systemic lack of profitability. So a new insurance company, a new insurance carrier, particularly in auto insurance, is going to have what I would call systemic unprofitability, right? Which is to say that the natural structure of the business means you pay quite a bit of money to acquire customers, no matter what channel you use, and those customers churn at a certain rate. They have a loss ratio at a certain level, and so the payback period is a certain amount of time. And so I don't make money on a customer for some fixed period of time, and if I keep adding more customers to that pile, then I don't make money until the number of customers actually producing cash for me is greater than the customers that I just signed up that are not producing cash for me. So there's a J curve in the business effectively where you are systemically unprofitable at a certain growth rate until essentially the renewal book is big enough to outweigh your book of new business. That can't
Yeah.
avoid, not much you could do. You can tweak it, but like that's like a natural evolutionary law of building a new insurance organization. There's also non-systemic lack of profitability or unprofitability, which is like running loss ratios that are obscene and like doing things that even if you gave yourself enough time, you would still be unprofitable because the business has these like foundational elements that are broken. And so our goal is to build like a systemically unprofitable company, which is a weird thing to say, but essentially to be unprofitable for the right reasons, not the wrong reasons. So the first thing I would do is say, like, I'm willing to accept being unprofitable, but I need to make sure I understand why I'm unprofitable, and it's for the right reasons, not for something that I should be able to control. I'm just choosing not to. To your question on managing spend in direct in particular, I mean, look, I think you see these companies starting to work in the independent agent channel, right? You read
Mm-hmm.
Metromile's earnings announcement; they're talking about working with IAs. Like, I think everybody is coming to a realization that we came to probably 24 months ago or 36 months ago, which is like, um, put simply, we back to these four inputs, right? Every sort of great insurance customer experience is some combination of transparency, convenience, low prices, and superior value. Those are the only four inputs to that experience. But every customer or groups of customers values those inputs or defines them slightly differently,
Yeah.
right? So if you are only focused on the direct segment, you're going to get a specific set of definitions around those four things. If you broaden your definition of those four things, you're going to find some people they define superior value and convenience as having an agent tell them exactly what to buy so they don't have to think
Mm-hmm.
about it, right? And that like and they their version of low prices is like, look, or transparency is like having somebody shop on their behalf. So I think we're all sort of expanding our worldview in terms of what these four inputs mean. And as you do that, you very naturally see that like there's more than one way to serve the customers, more than one channel that makes sense. So if I were these companies, I would do what we're doing, which is essentially say, how do I build my organization such that I can work across multiple channels so I can hit multiple definitions of those inputs? Because ultimately, if I want to serve and build a large customer base, I'm going to have to serve more than one definition of transparency, convenience, low prices, and
Ooh,
superior value.
bringing it back,
I
wrapping
know,
it
dude.
up.
I know. Jeff, you always lead me the right way, but this has been great. And you know the thing about you, Kyle, you're calm and cool. You're just like you're very structured. You kind of
Mm-hmm.
know what you're gonna say or not, and it's really, really. I mean, I'm sitting here thinking, I'm like, dude, this dude's gonna be like the #1 CEO in 10, 15 years. I swear to God. Kyle's thinking, well, the cast it should be three, but I'm trying to be realistic here, Kyle.
We got a
Um,
very long way to go.
I got a question before you ask another one, Jeff. Is that you were talking earlier, Kyle, about your guys' claims process, about how someone can submit a claim and they can get it done, do AI and stuff. But there's been that new recent thing that Lemonade got their butt burned on that. I mean,
Yep.
just reading an article, we don't really know what's going on. But I mean, how is that affecting you? I mean, can you elaborate on that? Does it not have anything to do with you?
We don't do some of the things that they're doing, so we didn't really have to deal with it. But I think
Okay.
we use AI in a bunch of parts of the organization, and you have to like we have some very smart people who also understand the ethics of using the tool. And it's not that Lemonade doesn't. Like I think
Right.
I
Right.
suspect that between us, like I suspect Lemonade was careful about what they were doing, and they have a ton of really smart people, and like they have solid ground to stand on with respect to what they're being what that
I
the
agree.
article had to say about them. So
Hmm.
we'll see. But on our side, um, it's just about like being aware of the ethics of the tool that you're using and making sure that like you don't get too wrapped up in what's possible and pay attention to like what you should actually be doing with the tool. It both again like I back to our four inputs. Like if I'm using AI to give you a more convenient experience, but along the way I destroy your trust, then I'm not delivering on superior value, nor am I delivering on transparency. So it's just about keeping those inputs in balance, right? There's a bunch of stuff I could do to deliver on one that will destroy the others, and those are things I probably should not do.
Whew. Love that, dude. Way to be,
I have another one.
Jeff.
So California has 45, almost 50 million people. Florida, 24. New York, 24. Michigan, 12. And let's throw Louisiana out there. All these companies with lifetime PIPs, right? Which state do you think will be the toughest challenge for Clearcover, not to grow in, but to be profitable and keeping the combined rate down? Which state will be the biggest challenge to your company?
And
Interesting.
he throws Florida and California in there.
Just pick the best DOI companies.
His
So
Look, I think that all of those states present unique challenges. We're in
mhm.
California. I think California has been a bit of a struggle for us on the profitability side of the house. In part, that's because we made our own mistakes entering the state, which we are now still working to correct. So um, I think that again, like I don't know if I could pick one. I think they're all going to be hard. Um, they all are hard. But what I'll say is you get to choose as an organization how hard you make that on yourself, right? The analogy that I use with my team and I tend to use with our investors is profit and growth are two sides of the same string, and that string isn't very stretchy. So if you yank that string to one side, you're going to pull the other side with it. So if I want to grow super, super fast, what's going to happen is I'm going to yank that string over here and profit's going to go with me and it's going to go in the tank. And if I want to be super, super profitable, then I'm going to yank that string the other way and growth is going to go away. And you see this happening in the public markets right now. This is what
Yeah.
happened to a bunch of companies who were growing super, super fast. And the market said, no, 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 be profitable. And they tried to stretch the string. And what actually happened is they just yanked the string the other way and now they don't grow anymore.
Wow.
And so our job, regardless of state, is to find like a middle ground, to understand, acknowledge that the string doesn't stretch all that much, and try and find that proper balance in the middle. And to your point, like balancing that string in California and Florida and New York might be more difficult than it is in other states, but it's still the same challenge, which is like, look, how do I make sure I'm finding this right balance of growth and profit, and along the way I'm treating customers properly? And I think at the end of the day, we'll get it done.
So one of the things that I want to add to this, I've talked to a company, one of the insurtech companies that is an animal in Africa, and they were telling me that one of the things that they do. I was in their headquarters in Austin, and I'm talking to them, and they said that one of the advantages they have is they look forward to going into a state like Florida. And their reason is that they don't carry any of the underwriting. They only get paid a certain percentage, like let's just say I'm making this up, 25% of what the premium is. And then they were keeping a little bit and then passing 10 to 15% to the agent, right? But their thought is they look forward to going into things like a Florida or a California where it's higher because the premium's higher and that's how they're making their money. And I think he said they were offloading the underwriting to like the reinsurance companies. Am
I
I
think
right or wrong when
I
I'm
think
saying that? Does
that's
that make any
cat.
sense?
Like they pass on all the cat, and they believe if they can limit their exposure to litigations, then all the other lawsuits are just cat related. If I'm thinking that one correct.
It's something. I mean, when he told it to me, I'm like, this is way over my head.
I mean,
Any
look,
thought on
there
that,
is a
Kyle?
dynamic out there. There are multiple companies, even someone like even someone like a Root or a Lemonade that uses reinsurance pretty heavily, right? Like there's this idea of like the capital light model that's being thrown around, which is the notion that I'm not going to carry a lot of the risk on my balance sheet. I'm going to sell the policy. I'll take a commission. Somebody else is going to carry the risk on their balance sheet, so I don't have to hold as much money in reserve, and like I'll offload some of the risk. That is a real concept. There are many companies, including ourselves, who use reinsurance to offload a lot of the risk.
Okay.
But I think what I would say is you have not offloaded the risk per se. You've just shifted the direct ownership of the balance sheet controlling the risk to someone else. Because walk down the chain of inference here. So what's going to happen if you write a bunch of terrible business, which you subsequently offload to a reinsurer who then loses their ass on it? You're not going to have a reinsurance deal in a year or two, which means it's all
Right.
going to come back on your balance sheet. So there's no escaping the gravity of bearing risk. You just create a longer chain of connections to that risk when you use reinsurance. And that's fine. It works. You just
Mm-hmm.
have to acknowledge that. There's no such thing as like it's somebody else's problem,
Hmm.
because it will cease to be their problem and it will now become your problem. And so like you just have to know that that's the reality of using reinsurance or pushing risk down the chain. It's still your problem. It's always going to be your problem. You just shifted the money on the balance sheet somewhere else.
Gotcha. Wow.
So
That makes sense totally.
since you were talking about smart people, right? And shout out to Nick Showell, shout out to Scott Johnson from Clearcovers.
It's our
Um,
squad.
the first time I talked to those guys, I was like, man, these guys are awesome. And then I saw the second guy, third guy, whoever from Clearcover, we have had great experience working with Clearcover team. Do you have any story you want to share on this podcast of how you pursued it some of the people just join Clearcover say, hey, my name's Kyle. I have this great idea of Clearcover. I think you are a smart, cool individual. I want you to join our team. I got stories for Quantum like that, but I would love to hear some of your stories. And, feel free to go in.
Yeah, I'd love to hear yours too. Quantum is a partner of ours. Quantum is great. Our
Yeah.
team teams have done great work together.
Hmm.
I would say every like recruitment journey is a slightly different, right? They're snowflakes. They all have like slightly different flavors to them. I'll tell you. I'll give you stories, but they're probably less relevant than the framework we use. Let me give you the framework we use to think about
Okay.
hiring because I think is more useful. Um, the, there are only four things you can do as a startup trying to recruit people, right? There's only four places you can land, and most people mistake where they are. So everybody thinks they only hire A players, right? Like everybody says, oh, we only hire A players. We just hire A players. We just hire A players. There's only four ways to do that. So one is you overpay for talent, right? Like one way to land all A players is to overpay for talent. Another way to land A players is that you are world class at convincing people to work for you for less money. The other way is that you are world class at identifying a talent before they know they're a talent, and the market realizes they're a talent. And the fourth is you're not actually hiring a talent, right? Those are the four things. You overpay people, you're world class at convincing people to join you for less money, you get people before they're actually worth that money, or you're not actually hiring a talent. Almost every startup thinks they do the middle two, and they do the outside two, right? Almost every company thinks they do the middle two and the outside two. So what we focus on is like where are we falling here, right? Like let's be honest with ourselves and each other. Why are we landing this individual? And like if you ask yourself, like you could probably, Jeff, look through your company and say, like, of the best folks that we have, when we hired them, like where did they fall on those four things? Like, were we just smarter than everybody? We saw them first. Did we overpay them? Did we convince them to join and take less money to do it? Like that has been every employee in our organization that I have hired personally, I could put into one of those four buckets, and like I have people that fit in all four.
Wow, that is great how you broke that down. That is really, really good stuff.
That is really good
Um,
stuff.
and and the thing is, when they hire them, it always makes me think when I hear smart people. And Steve Jobs blows me away on this when he said we don't hire smart people and tell them what to do. We hire smart people and have them tell us what to do. I remember hearing that when I was younger, and I thought to myself, like that was big for me as a business owner. I had never really thought of it that way. I thought I hired smart people so they could do the things I wanted them to do. I think there was definitely a change in my business when I started hiring them and then saying, "Hey, what should we do?" Right? You're the smart one. I thought that was pretty good. So that's
I
cool,
think
and that's a
that's
good
right.
way to determine them. Jeff, that was good stuff, wasn't it?
Yeah. I got one more. Throw another fun
All
one
right,
out
one more
there.
question, and then we're gonna wrap up. And Kyle's got to get to lunch. So yeah, go ahead. Actually, what you're in California? You said, Kyle, right?
I'm just outside of Chicago, so I'm Central Time.
Oh, okay. You said you guys are
We're
writing
we
business.
write in California. Yeah, we're
Oh
based in
yes.
Chicago.
Okay, so I didn't know that. Real quick, Jeff. So I'm down in Edwardsville then to answer your question that you asked me earlier. Right down
Got
by
it.
SIUE, right down
Yep.
there.
Yep.
You
Yeah.
guys
So that's
probably
where.
could get together and grab some
Yeah, I
Chicago
didn't know you were in
pizza.
Chicago. So yeah. But anyways,
Um,
Shout out to
so
Pequod's, which is the underrated deep dish in the city. Everybody's gonna take you to Lou's and Giordano's, but Pequod's is
you,
the top.
I have never had Chicago pizza in my life.
We come
I
up.
gotta admit,
We'll go out.
yeah. And Kyle, wait a minute. What did you say the other one? Because you said that there's a main one, and but Giano's. But what was the one you said?
So Giordano's and Lou Malnati's are like the two big names that everybody's
Yeah.
gonna go to. They're fine. Pizza's good. Pequod's is like just north of the city, and it's the best deep dish in the city, in my opinion.
Okay. Sweet. I'll have to remember that. I'll have to remember that. What do you got, Jeff?
So this year we saw, Allstate made the purchase of Save Auto, NetGen, and rolling out NetGen Premier. State Farm buying Gainesco, rolling out 50 states. Zurich buyout, MetLife, right? The PNC side.
Mm-hmm.
And who was the other one? Um,
There are a couple other
Liberty
ones.
Mutual bought out Stay Auto, right?
Yep.
The buyout usually like dollar for the premiums, right? And there's a couple guys on the sideline. One of them is your ex company, American Family,
Mm-hmm.
and Chubb. Chubb made a big offer to Harvard that got rejected. And then there is Berkshire. Who do you think is the next to go in for the second half of 2021? Use your crystal ball to predict the next big money to drop, and who are they buying if it was your money?
Yeah, that's a good
You know,
question.
choices are there: Erie, Grange, Central, Westfield, right?
Erie ain't
So
going nowhere.
I don't know. We're in different
Yeah,
time zone now.
Okay, it's true.
it's a great question.
Make a
I don't
prediction for
know.
2021.
20, yeah, for the rest of the year.
One of them got to drop, right?
Yeah, I would actually probably, I don't think a lot in personal lines. Maybe something in commercial. Here, let me do this. I think there's going to be continue maybe next 18 months, and I couldn't tell you the company, but I think there's going to be a continued interest by the very large personal lines companies in acquiring non-standard capabilities because that continues to be an important and growing segment of the US driving population. And I think a lot of these folks are ill prepared to serve that segment properly. And in fact, I think that's a segment that really deserves more attention. And like folks, like for whatever reason, there's not like a good premium brand in that segment. Like there's not a ton of businesses out there that like treat some of those drivers like humans. And so I think you'll probably see in the next 18 months more of these folks making more of a play to acquire these like non-standard, near non-standard capabilities because it's again like
Wow.
super important part of the driving population and one that they mostly just give the Heisman to.
Right. Wow.
It's a good answer.
That is a good answer. Yeah, I heard that it was only a matter of time. Now, I heard it from someone who probably didn't matter, but it was only a matter of time before that Chubb and Hartford thing, they did come to an agreement. And then I'm not saying it's like next month or next year, but they feel as if that was a good match to be made. Any thoughts on that, Jeff or Kyle?
Jeff, you would know
No?
more than me.
Yeah, I have no idea.
I know nothing.
Yeah, I know nothing either. And it's
Jason's
crazy because
all on the inside on that one.
Kyle, I was thinking that you would say that there'd be personal lines carriers make a play for more commercial, since commercial is a bigger premium sometimes because no one really knows what the personal lines market is going to be like in 5 years. It's so crazy with electric cars and all this stuff,
Hmm.
you know?
I think you
So,
might see some startups come together too, right? I think like multi-line by merger is actually a path of less resistance than multi-line by construction for a lot of these folks. So I think you might see some startups start to come together and join forces to be more competitive than they are apart, but we'll see how that plays out
if
too.
a startup buys another startup, is it still a startup?
That's now we've gotten to the most existential of the questions. And I don't know because if I can't call myself a startup, I don't know if I can recruit anymore. So I'm pretty sure I'm going to be a startup for as long as I can until somebody rips it out of my cold dead hands.
Oh man, that's great. That's fantastic.
Are you under pressure to go bundle to offer commercial and umbrella? I mean, to offer a home and umbrella?
It depends on the channel. Like I think one of the things we love about working with our agency partners is no, because our agent partners can help our consumers solve that problem, right? If convenience to you
Mm-hmm.
means bundling, the agent can do that on your behalf, and I don't have to build the product to make it work. So, in the direct channel, more so. In some partners, like more so. So, I would say not in some channels, yes, and it's also very segment driven. I think like if you look at our book, it tends to skew younger and it tends to skew less preferred just by virtue of who we are, and so a little less pressure just by the nature of our book right now. But we'll have to get there, right? Like again, like I can't back to different definitions of transparency, convenience, low prices, and superior value. Like if you are a homeowner with a boat, I literally cannot offer you a convenient experience today unless you go with an agent. If you don't want to work with an agent, I don't have a convenient experience for you because I can't help you solve the rest of your insurance problems. So, we're going to have to evolve to meet those different definitions of those four inputs as we grow.
So Kyle, to add to that though, so like if I'm an agent, which I am, and I'm selling you, and then I do need to sell the auto and the umbrella, I like to have those together. So will you be creating a product, you think, though, that will allow me to help bundle that person?
We do. We're actually working on this right now. So first thing we're gonna do is step into multi-line discounting. So just to make sure the agents can still offer the discount on the auto, so long as they are bundling with a home product.
Gotcha.
And then
Mm-hmm.
umbrella is the next issue. Like I think I would love to find a way to help our agents find more robust umbrella options when the products aren't bundled with the same carrier, right? Like I think at this point we still get some feedback from agents where it's like, look, if I put auto with you and home with this company, it can still occasionally be difficult to find a good umbrella, like a reasonably priced umbrella. So that's probably another thing we'll have to look into.
Yeah, it really is. It really is. And and it's just giving a shout out to Glovebox. That's one of the beauties that people don't realize whenever we have these multiple companies, right? I got it with Clearcover, the auto. I got the company B with the home. And it's like, and you have these companies saying, well, just download our app, because that's all you'll need. Well, not really, because they have 3 different companies for 3 different policies. That's what I love Glovebox does, is comes in and allows you to have all that, but still in the same spot. Love those dudes. Love those dudes. Yeah. So, Jeff, this guy's got to go. I got to go as well. I got to sell insurance. You got to get back to that meeting and let everybody know how smart you are. I always say that about Jeff because he does. Yeah, he hits me behind the scenes. Just you loyal listeners know he's always hitting me on Facebook chat, asking me questions. He always sends me statistics. Cass, what do you think about this? I think he thinks that, like, he doesn't know that I failed algebra twice, right? He doesn't know that I don't know any of that stuff. But, it's okay. Jeff, I appreciate you. And Kyle, wrapping up, anything you want to say, man?
Thank you you both for the great questions, and thanks to the audience for listening in. Appreciate the chance to be on here.
Jeff, you got any question? Any last thing you want to say?
No, I'm in Des Moines, Iowa for InsurTech event today. So, I'm watching all these InsurTech company pitching these founders. It's pretty interesting to watch. So, Kyle, pleasure meeting you. And maybe we take up on that Chicago pizza offer one day. And then I'll fly in, you, Jason, me, we'll grab some pizza.
Deal.
That's right. Iowa is a hotbed, as we know, of insurance. And one thing I love about Iowa, and I always say this, it's clean. You drive down the streets and the roads are clean. There's not trash places. And I'm not saying everywhere in America is like that. But a lot of the places I go, it's like, oh, this is a normal American place. When I went to Iowa, I was like, wow, it just seems really clean around here. It was really, really, I really liked it. Now, it's really flat. But so is it in Southern Illinois, so that's okay. Just once again, thank you very much, Kyle. Thank you very much, Jeff, for your time. Hey, I want to just let you loyal listeners know that this is why I do, because I do it for you. I want you to be able to hear people like Kyle. And, Kyle, I have to say this, and I mean this with all my heart. I actually was thinking about calling my business partner today and telling him that I want to have a meeting because I think it's time that we strategically stop looking at, hey, I need to get Cincinnati insurance. Hey, I need to get nationwide insurance. I need to get these carriers. We need to actually start putting it in our head as independent insurance agents, loyal listeners, that there is Clearcover. There is a Hippo. There are some of these others. Now, I will tell you this personally. This is Cass talking, Kyle and Jeff. This is no one else. Lemonade made me mad because I told them years ago that they were going to need the agent channel. And one of their VPs or whatever, was a woman, she looked right at me and she said, there will never be a day that we will sell a policy through an independent insurance agent. And this was like 2018, it was right at the beginning. And I was just like, okay, you didn't learn. You didn't learn. I learned it at an early age with Progressive. Progressive came out, they were online and everything. But their growth kind of started to fall after a while until they really developed their business model as the independent insurance agent, and it helped shoot them off. And we see that so much, We don't need the IA, and then all of a sudden they do. You know what I mean? And that doesn't mean it's bad. You have a new business model that you think, hey, maybe this can work in a different way. And then you find out it doesn't, I think every relationship and every product we have, we end up finding out where it really works and it doesn't.
Look, we made the same mistake. And what I'll tell you is what we learned is customer centricity demands it. So regardless of what we thought we knew, when we got to know our customer, we realized that this is a place where we had to play and that, this was a great place to build our company.
Wow, that's fantastic.
Jason, I'd love to do an episode with you on the rise of InsurTech.
The what?
The rise of InsurTech.
I know that's a big one. This InsurTech I gotta go. I know, but as independent agents, guys, we've always seen that over there, right? Like we're the independent channel, and there's the InsurTech companies, and they're kind of trying to help the carriers work with us better. But it's a different equation when people like you, Kyle, come in. When Hippo comes in, when Lemonade comes in, it's like no, guys, we're not in a separate set. We're kind of actually in bed not in bed, we're embedded in you just like it would be with a Nationwide or somebody else. And I think it's going to take a year or so for these agents, and it's going to take people like me and people like Jeff and Ryan Hanley who are going to start using you, and then agents are going to go, oh, so those people are for me, you know? And what they find out is what we're finding out is that, yeah, they're the company that you always wanted to give you your client the digital means that they're actually requesting, but you don't have because these other companies don't offer that. So thank you very much, Kyle, for that. I really do appreciate it. Jeff, thank you very much. Loyal listeners, you know I do what I do because I do it for you. And please tell me your thoughts and tell me your ideas, and I'm going to tell the world what you have to say. This has been Cass, he's Kyle, and he's she, and we are out.